Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Wei Li joins us this morning for an extended conversation. Wei Li, I want to go back to first principles. My great mentor in the United Kingdom, he has recently died, Meghdad Desai, Lord Desai of India and of the United Kingdom, would say it's just about profit. What is the quality, the physics of technology profit that makes you committed to Mag 7?
Well, it is about the quality of profit. It is also about the reality of earnings coming through really strong, right? We're not putting hypotheses out there. We're just looking at the ability of these companies to generate earnings, to generate profit. And so far, if you look at equity attribution of various markets globally, US really stood out in being able to deliver earnings to justify the performance, and tech and Magnificent Seven in particular really stood out at in terms of their earnings, basically explaining almost all of their performance so far this year.
When will you know the profit of all this CapEx investment? Are you going to know that somewhere next year, or do we have to wait 10 years to know?
Maybe somewhere in between, actually. That's a very good point. So far, phase one of this build out has been really companies spending their free cash flow, and they are awash with cash to invest in this mega deal. But we're now entering phase two, where perhaps the build out is more capital intensive. We're talking about some new entrants tapping into bond market, into private credit, into joint ventures to fund some of this investment, and vendor financing is seen as well, right? So phase two is more capital intensive, and timing is everything. You know, we can be right about the revolutionary nature of the technology, but we can still have a very rocky markets on our hand. So what we're seeing right now is trillions of capex being kind of talked about and estimated in the coming years, but time will tell if we have the right return on investment to justify those investment, those capex commitment. But in the meanwhile, we cannot afford to stay out of this market. So signposting is everything. Looking at earnings, looking at free cash flow, in particular of those companies that are going to be consumers of this capex investment, is how we are navigating this moment.
Wei, we are, in fact, in the middle of earnings season. That's a good thing. We saw some pretty strong numbers out of the big money center banks, and now we're getting some industrial companies reporting. But it seems like geopolitics is not far off the radar for this market. China, in particular, trade discussions with the U.S. How do you think about that? Is that something you just try to ignore? Do you try to play it? Because it seems like the trade talks with China and what that means for global GDP over the coming years are still front and center.
It's really hard to follow the headlines blow by blow, right? Like from one moment we hear that maybe we're going to get a good deal between US, China, and to the next moment where maybe the meeting won't happen. So it's very noisy in terms of headlines right now. And if you look at the Bloomberg US Trade Policy Uncertainty Index, it peaked in April, but it recently started going higher again. So markets are reacting quite a lot to it, but I think it's very hard to generate alpha by just following headlines. So focusing on the things that cannot change very quickly in the near term is how we're trying to navigate this environment. So inflation considerations for the US, but also thinking about the balance of payment for China and how important that is. And if markets get carried away, we would lean against the extreme pricing, because these things cannot change very quickly, which is why right now we're still pro-risk despite the very busy trade headlines.
Wei Li with BlackRock with us for an extended conversation to start strong. Elizabeth economy on China in the 9 o'clock hour. I just put out on LinkedIn my LinkedIn of the day. It's Wei Li. Really? I had to be polite,
nice. Okay.
Did that.
Thank
but
you.
It's a great Bloomberg screen of the margin difference between S&P and large cap versus small cap. Wei Li, it's back 30 years. Can I say it's never been like this?
I think we're seeing some extraordinary K-shaped developments. The chart that I put out, the Bloomberg screenshot that I put out on LinkedIn, is the profit margin of S&P 500 large cap and S&P 600 small cap, and they're really starting to diverge. But that's just one manifestation of this K-shaped development, right? We see K-shaped recovery of the consumers. We see K-shaped kind of default type of pattern in credit, and also including in private credit. I think in an environment where we don't have rising tide of very easy policy lifting or boat of very easy fiscal stimulus kind of supporting everything, being very selective in terms of how we deploy risk is going to be the name of the game. We see credit markets. You look at the cycle, there is almost a missing credit cycle, but digging under the hood, fundamentals support the very strong large caps awash with cash, whereas the very small players are currently under pressure. So K-shaped development is a characterization of the environment that we're in, and I think that's here to stay for a while.
Wei Li, can you talk to us about geography? Where do you see, I guess, best opportunities, maybe U.S. versus rest of the world? Are you focusing on Europe? How do you think about, from a geographic perspective, where some of the opportunities are out there?
We currently actually still like U.S. equities, and we also prefer Japanese equities.
Really?
And we favor them over, for example, European opportunities where we would want to be a bit more selective, financials and industrials, how we want to play that together with defense theme. And the reason that we still favor U.S. equities, you look at how markets have developed so far this year. U.S. equities became a little bit more expensive, but not as much as how much more expensive, i.e. re-rating, has taken place in the rest of the world because of the stronger earnings delivery in the U.S. market. You look at the earnings revision the last 2 months or so, U.S. earnings have been revised higher versus European earnings having been revised lower. So the direction of travel very much speaks to kind of the underlying economy and the concentration of the AI theme. So for as long as I think we're still in this AI conviction, AI core, it will be hard to fade the U.S. equity market at this juncture.
In the fixed income space here, I mean, you can sit there at a 2-year treasury, get almost 3.5% here. That seems to be not a bad place to be here. Do you sit there in the U.S. treasuries, or do you maybe take some credit risk out there?
For our Q4 outlook that was released, now we're mid-October, that was released almost 1 month ago, we upgraded the long duration U.S. treasuries because we felt that the Fed is getting lucky a little bit because it is embarking on restarting the Fed cutting cycle, and the macro environment actually supports that, i.e. labor market is just weak enough for Fed independence not to be under scrutiny as it restarts cutting cycle, right? So as we kind of still are in this environment, the Fed is still getting lucky in that, like we heading into next week, I think 24 bips of rate cut is a foregone conclusion. We do want to lean into this momentum and lock in some of those really attractive real yields in particular. So we like treasuries at this juncture.
Well, that's right where I wanted to go. You're reading my mind. And Paul, I'm glad you brought it up because I've been real equity-centric focused. I got a 3.95 10-year yield. Is this finally where we get the inertial force to lower yields? Do we finally break down to a lower real yield, lower nominal yields?
Well, we do think that in the very near term, markets can go with this narrative that because of weak labor markets, actually the Fed needs to cut. And because there is macro justification for that, maybe the long end of the curve is not going to be penalized in that term premium may not go higher as markets challenge the Fed independence topic. So there is a bit of a sweet spot for treasuries. Now, having said that, heading into next year, if you look at the market pricing for policy path, we're talking about below 2.9% by the end of 2026. I think given the still broadly inflationary environment, we're still waiting to see the impact of tariffs feed through to CPI trend, for example. I think market pricing for below 2.9% policy rates by the end of next year is too optimistic, but we may not get to the awakening moment just yet, which is why we're tactically overweight.
I've got to ask you, Wei Li, with your heritage and your academic excellence in China, we have Elizabeth Economy coming up of Stanford later. Wei Li, your thoughts on this important set of meetings to a new 5-year plan in China?
Well, this is an economy that needs to go through reforms, right? Like this has been talked about for many years now. It needs to go from an investment-heavy driven type of growth model to consumption-heavy driven type of growth model. And right now, consumer sentiment still is somewhat tepid. So I think how to energize that is going to be very key, especially against the backdrop of aging population and structural headwinds to economy. So that's a very delicate balance. But the key here is mega forces and specifically navigating and capitalizing on the AI revolution.
Wei Li, thank you so much with BlackRock. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a conversation of the week, but dare I say, folks, here in October, our most important hydrocarbon conversation to the end of the year. Edward Morse is absolutely iconic, made more so. It's Citigroup recently screaming at the oil perpetually over $100 a barrel. People going, maybe not. He is right. He was right, I should say, and still is right. At Hartree Partners, Ed Morse joins us with all of his service to the nation, Senior Fellow Counsel on Foreign Relations. You open up classic Ed Morse, supply and demand, and the increase of oil on the water. What is oil on the water? Is that boats?
It's actually tankers. And they're either moving from where the supply is coming from, going to where the demand is, or they're just not going anywhere because there's nobody who wants the oil. So we've had an incredible surge in oil on the water. That surge has come after the summer demand season is over. It's come as OPEC Plus has added oil to the market. So estimates were 1,250 million barrels of oil in transit as of a week ago. And that's the most since 2020, which we all remember when oil prices went negative.
Well, oil prices went negative. And again, you said look for lower prices. The acclaimed Bloomberg Businessweek cover of years ago of tankers off Singapore just sitting in the water. Is that what 2026 looks like?
Well, 2025 certainly looks like it's going to end that way. What happens in 2026 is partly a function of what the OPEC countries decide to do. Are they going to continue to put more oil in the market? And the other big question is China. China has absorbed most of the excess amount of oil in the market. That's why inventories are so low around the world other than China. They were importing an average of over 1 million barrels a day to put in storage. That's geopolitical, of course. They've kind of slowed down a little bit, related, I'm sure, to U.S.-China talks, but those seem to be going nowhere. So China is part of the issue of how much they're going to suck in to build their own inventory for some future date.
WTI crude oil at $58. With WTI crude oil at $58 a barrel, is there a global glut of oil in the marketplace?
Well, it looks like that. That's what the oil on the water is telling us. There's a glut. It's showing up. It's beginning finally to show up in inventories. But the inventories are so low, they have a long way to go. Okay. But yes, there is definitely a glut. Supply is significantly more than what demand is at the moment.
So what is this? If I'm sitting down there, I watched Landman for one season, so I know all about the oil and gas business. I'm an expert.
In Austin, at the F1, at the Sweeney corner, was the big advertisement for Landman.
So I know all about the global energy business. What's to fix that? I mean, if I'm in Houston, I want $75 a barrel, don't I?
Well, if you're in Houston, you want the highest price you can get. So yes, certainly is higher than WTI at 58. And we'll see how they're doing. You know, the U.S. hit record levels of production in the month of August.
Did they? Wow.
We don't have the full data yet, but there's no sign of there being, a downturn in U.S. production. I think among the things to look at the moment in the month of November is whether the Crown Prince of Saudi Arabia is going to come to the United States.
November 18th seems to be the schedule. How will that response be? What will be the oil discussion in the Oval Office?
Well, I suspect he's not going to come if earlier in November they decide to not put more oil in the market in December. So I think that'll be a signal.
Okay.
I think they're looking at 3 or 4 things. They've noticed that Qatar has gotten a NATO-like defense agreement with the U.S. government. They would certainly like something similar to that. They are more important in many respects to the U.S. and to Trump's desire to have lower gasoline prices at the pump. They're looking for a military deal similar to the one that was struck when Trump was visiting Riyadh last spring, and that was just about $150 billion worth of military equipment. They're particularly looking for F-35 fighter jets. Are they going to get any at all? Are they going to get what they want? Is there going to be a nuclear agreement? Are they going to be seeing U.S. technology and U.S. material come in as they build nuclear energy for power generation and free up more oil for export?
Ed Morse with us. We continue right now with Hartree, and of course, iconic. It's Citigroup and his assistance to the country in studying oil, particularly within the Middle East. 2012. I remember this article. Matt Bessler came out of Michigan, great academics and economics in Michigan, writing for Business Insider. It's just a classic headline. Citi's Ed Morse has a huge note blasting everyone who believes in peak oil. This is the feisty Morse from years ago. Peak oil biases continue to blind analysts to an emerging oil cycle turning point. You nailed it. Matt Bessler, I should say, is now with Bloomberg, and that's to our advantage. You nailed it. What's the myth right now in oil that's wrong?
The myth that's wrong is that oil demand is peaking. Whether it's peaking in 2028 or 2032, the consensus in the market seems to be that oil demand is peaking. Yet, if you try to study oil demand, you can notice that whatever the cycles have been, GDP is the driver of oil demand. And GDP relationship with oil, the oil intensity of GDP, is certainly falling. It's been falling at a steady pace. It's a very linear line from where we were in the early 70s, when for every 1% increase in GDP around the world, and we do this in constant dollars, by the way, there was over 1% demand for oil. That has come down linearly. And we just looked deeply at 2020 through the first half of 2025, and we're on a slope that tells us that oil demand is going to peak in 2064.
Okay, well, that's out there. Lisa, make note of that, 2064. Ed and I won't be around. Ed Morse, what's your target on oil here now? You were so good at 100 saying think 80. At 80, think 60. Can Ed Morse think $40 a barrel?
I think it gets to 40 by overexuberance once it crashes through that $50 number. So I think there'll be a lot of reactions at under 50.
What does $50 barrel oil mean for the Middle East, and particularly for Riyadh?
It means a little bit of difficulty on the credit side. So yes, they have a fiscal break even that is substantially higher than $60 Brent, but they get in trouble with their A+ rating on credit. And they need the credit, they need the lending in order to make their own energy transition, which is to diversify their economy and get off of dependence on crude oil.
John from the Jersey Shore emails in. He says, with my Hummer H2, what's a gallon of gas cost at Ed Morse is 40. I mean, where are we, under $2?
Wow.
$2 a gallon?
It depends on where in the country. If you're in California, it's a lot higher than that.
That's an Ed Morse answer.
That is. Yeah, there's always the California
it's close
exemption.
to 2.
Absolutely brilliant. Are EVs having an impact on the price of oil?
Of course they are. They're part of the system of replacing oil with something else. And if we look at the declining intensity that oil has in GDP around the world, we're having an increased intensity of GDP in electricity. And that's where the geopolitics are turning as we look into the next decade.
Yep.
Please come back next week. Ed Morse with us with Hartree, folks. What a briefing there for Global Wall Street. Edward Morse with all of his service to the country, the discussion of oil, the geopolitics of oil. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I have been asking for days, please, Elizabeth Economy of Stanford. Dr. Economy joins us right now, definitive on the Trans-Pacific debate. Liz Economy, just the prism of 7, 8, 9 military commanders out the door in China. How do you interpret that?
I mean, honestly, this has been 13 years worth of a continuing anti-corruption purge. It sounds like a lot, and it's not insignificant, particularly given that 3 of them are members of the Central Military Commission, which is the top body that oversees, the party body that oversees the Chinese military. So that's 3 out of 7 that were just purged. So it's not, inconsequential, but, Xi Jinping, this is just a continuation of, a purge that just never ends for him. What does that say about the nature of how he goes around dealing with corruption? I think it suggests that he hasn't found the proper method to deal with this because,
right.
It's ongoing. And these are people that he himself put in place. So it's not about finding people who are more loyal to him necessarily. These were supposed to be, loyal compatriots. Right. It's not a good look, but frankly, it's not that new.
So one of the problems here, Paul, and this is like the small life that I live with Elizabeth Economy. They have a book thing in the back of Foreign Affairs magazine, and Elizabeth Economy will be there and go, let me ruin your October, November, December. I have literally, Liz, in the top of my pile, the book you said, here's the primer on the military power of China. Bloomberg Surveillance just spoke with Admiral Mullen. And we talked about the South China Sea. Give us the Liz Economy update on the military capability of China and the South China Sea.
Yeah, I mean, I think from everything, and you have the book in front of you, so you can read it yourself, Tom. But I think the takeaway is really that China has made enormous gains in terms of its military capabilities, particularly in terms of sort of the near abroad, in its own backyard. It wants to be the dominant military power in the Asia Pacific. So that's been its priority. I think the weaknesses remain in terms of the command and control. The fact that China doesn't necessarily, hasn't had a lot of actual war fighting experience. So nobody really knows how good they'll be when put to the test and whether the top-down nature of control will enable sort of the mid-level military commanders to make the type of split-second decisions that you want them to be able to make. So there are some, weaknesses. And again, I think they haven't made, as much progress as they would have liked in establishing bases overseas. They want to have a larger footprint globally. They're doing that in terms of their arms sales. They're doing more military training of other countries, with the People's Liberation Army. So they have in place many of the elements of a global military presence, but they're not quite there yet. And I think that's, those are sort of the 2 major messages if we're trying to understand where the Chinese military still falls short. Those are probably the 2 main areas.
Elizabeth, for those of us on Global Wall Street, we're trying to keep a pace of the changing economic discussions between the U.S. and China here. Will there be a meeting with President Xi and President Trump later this month? What's your current read of the relationship, of the potential negotiations, and how this all might shake out?
Yeah, I mean, I think, odds of there being a meeting are quite high right now. looked less good, a week or two ago when we had the most recent sort of tit for tat with the U.S. export controls and the Chinese controls and new licensing restrictions on rare earth elements. So that was, I think a huge dust up. But President Trump has pretty clearly signaled that he expects to meet with President Xi on the sidelines of APEC in South Korea next week. So I take that as a positive in terms of what's likely to come out of the meeting. Look, the president has made clear what he wants. He wants, and it's nothing we haven't heard before. He wants China to do more in terms of controlling the export of the precursors for fentanyl. He wants China to, buy more soybeans, because basically they're not buying any soybeans from the United States. They've completely gone to other, markets like Brazil and Argentina. And he wants China to lift these new restrictions on the export of rare earth elements because that really hits hard at our technology and defense industries. For China, they'd like to see, the United States not discriminate against Chinese companies. Globally, they want the U.S. to lift its own export controls, particularly the last set, which basically places about 12,000 Chinese companies on the entity list, which is pretty, significant. They'd like the president to do something on Taiwan, at the very least, an affirmation of, the one China, what we call the one China policy, what they call the one China principle. They're slightly different.
I have to interrupt you. This is too important.
Sure.
What is the Elizabeth economy Gaussian distribution of outcomes with Trump, Xi, and China? What's the most likely thing in Taiwan? What's the most likely thing, Liz?
On the Taiwan question, I think the president is President Trump. I don't think he has much personal interest in Taiwan, much of a sort of personal sensibility of its importance, save the fact that we, import more than 90% of our advanced semiconductors from Taiwan, and that will continue to be the case despite all of the investment in the United States by TSMC, their major semiconductor manufacturing firm. So he's not going to get away from the silicon shield. But I think, the range of possibilities, I think, basically is, number one, that we sort of say we commit to, and I think this is on the outside, we commit, to, diminish our arms sales to Taiwan. I think that would be, a high priority for China. I think that's less likely, but it's a possibility.
Liz, a number of years ago, your book, The Third Revolution, was my book of the summer, folks. It's dated now. It's a short read. Let's bring that up to date. What's the fourth revolution look like, Dr. Economy, for Beijing and for President Xi?
No, I think the fourth revolution, my hope would be a new Chinese leadership with a sort of return to a more open political and economic system. The trend is basically every 30 years you get a revolution. And so we're not quite ready for the revolution. Xi Jinping's been in power for 12 years, so there's a long space to go yet to have that next revolution. I think what we're going to continue to see, frankly, in the foreseeable future is just an amping up of what we already have, which is just this incredible, investment in terms of innovation and technology, this ramping up of China's presence and its belief in its own leadership on the global stage. Which, can only be curtailed possibly by, a U.S.-led alliance pushing back against some of its worst practices and potentially by some internal factors, some of China's economic challenges that it's facing that it still hasn't dealt with. But I think in terms of the, next 10 years or so, I think it's all system goes for Xi Jinping in China.
Wow. Elizabeth, if Xi Jinping does sit down with President Trump in South Korea later this month, who has the leverage, if anyone?
I think when this all began, I was pretty skeptical about the U.S. Leverage with regard to China, which I think was built on the faulty premise that simply because we import so much more from China than China does from us, that gave us leverage, because it excluded the fact that we have so much more single source dependency on China for things like rare earth elements and for precursors for, hundreds of our most important drugs, right? Precursor chemicals, the active pharmaceutical ingredients. So I think that this, was the fundamental mistake that this administration made when it first launched this trade war with China, that it thought China was simply like every other country. And now we're paying the price for that. So in my estimation, China has the stronger hand, and at some level, it's always had the stronger hand. It's better able to tolerate the pain, from its population. It had done more to diversify into other markets over the past, 4 to 9 years. And so I think it's in a better position, unfortunately.
I got one final question now that you're ensconced out at Stanford. She doesn't give any A's. I mean, it's all solid C's for Elizabeth economy. She's at the Hoover Institution, and of course, with all of her work over the years for America and her public service, I should say, with Secretary of Commerce Raimondo here recently. Liz, when you teach at Stanford or the young people come up and say, OMG, Elizabeth economy, do you still tell them to read Jonathan Spence's The Search for Modern China? Is it still valid, as thick as it is?
Listen, I think Spence, I think there are many Chinese, historians of China. I think all of it's valuable because understanding the history of China helps you understand the mindset that China brings to the table today. So absolutely, I would continue to recommend books by Jonathan Spence, if in fact any students came up to me and said, oh my God, Liz economy. Although some students do come up to me.
And some of them probably say it in Mandarin. We got to leave it there. Elizabeth economy, thank you so much at Stanford. She's been a huge supporter of our effort here. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lisa Mateo with the newspapers. What do you have?
Tighter visa restrictions could be the reason behind a drop in applications for MBA programs in the U.S. They're saying a lot more of those international students, they're choosing to go closer to home. Wow. That's the choice they're starting to make. I want to point out the data really quickly. It says interest in MBA programs in the U.S. dropped 1% in 2025. Applications to business school programs worldwide, they increased 7%. And it's a big turnaround from last year when more people were going.
You mentioned at dinner last night, and there was a blurb yesterday in the zeitgeist of PhD, which is not MBAs. I'm going to use this word loosely, folks. PhD applicants at major schools have cratered because there were so many international kids involved.
Yep. And they tend to be full pay. The international students tend to be full pay. They're sponsored by their companies and things like that. So it's an issue.
John Silber, Boston University.
Nice.
He's the one that really efforted that.
Yep.
Brilliant. Anything else on that, Lisa?
Also, one more thing from that is that in East Asia, including China, international applications were up 42%. So that's kind of the big area that we're talking about, where they're deciding to stay home.
Yep.
Okay, so this next one, we mentioned Hermes earlier, so I wanted to kind of dig into it, get into those Birkin and Kelly bags, sure. Okay? So it was another quarterly sales jump, but investors wanted more, and that was kind of the issue. Their key leather unit, they fell short of expectations, even though it was higher than LVMH. But despite all that, it's still like top luxury brands. It's keeping their business models, keeping people hooked, keeping those items scarce, limiting demand. So you kind of you have to have that bag. It works. Don't take my word for it. I haven't jumped on one yet, but it does, because in the U.S., they're saying wealthy shoppers, especially in the U.S., are continuing to pick them up.
the U.S. really, you talk about tech and American exceptionalism, and the stock market, U.S. really popped, and even China there with a little bit
even China, that was a big thing. And what they say too, they increased the price back in May, but they haven't increased it since then. So I guess people were happier about that, so they continued to buy.
Hermes, LVMH.
You know where I saw a lot of Birkin bags? At the Commonwealth Conference.
Did you? Okay.
We went to.
Did you?
There's another. Oh, okay, very nice.
There you go.
Say good morning to Commonwealth. Thank you for supporting Hermes.
The keynote speaker at Commonwealth today is Coach K.
I'm surprised you didn't call him.
Yeah, exactly.
Next, you got one more squeeze in here.
Okay, so Six Flags, right? The theme park's been struggling. I remember as a kid, we always used to go.
Great adventure.
Bad weather, declining visit. So now an active investor is pushing for big changes. He's teamed up with Travis Kelce, yes, NFL's Travis Kelce. It's New York-based hedge fund Jana Partners, Kelce, other investors, combined stake of about 9% of the theme park operator shares, or $200 million. And he actually said, Kelce said he is a super fan. He loves roller coasters. He's been going to these things since he was a kid. So the chance to kind of work with him, he was all up for it. So he's starting to get into it. And so they have a couple plans what they want to do, like, marketing and customer experience, modernizing technology, refresh leadership, which was interesting that they said that, and even evaluate a potential sale. So we'll see what happens. But, they've worked with celebrities before, a lot of these activist investors.
CeCe Sabathia, Shaquille O'Neal. There you go.
Exactly. And those are some big names.
And the Chiefs, the fundamental thing is the Chiefs are doing better. Lisa Mateo, the newspapers, thank you so much. Greatly appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.